94 hit. Western futures closed at 94.3. Last video, I told you 94 was the next tape objective. I'm not even going to say I called it. At this point, that's just process. This is Jhon OG. I was the one highlighting the inverse head and shoulders at 72 while the crowd was screaming collapse. We're going to zero. Fear everywhere. And that's always when opportunity shows up. Here's what you need to understand. Trading and investing is bigger than charts and earnings reports. It's psychology, it's independent thinking, it's risk management. Watch what happens with a 5 to 10% move. Sentiment flips overnight. At 72, panic. At 94, euphoria. Now everyone's calling for all-time highs next week. That's human nature. The informed minority accumulates when it's uncomfortable. The majority buys when it feels safe. Don't follow me blindly. Don't follow anyone blindly. The moment someone tells you not to question them, walk away. Verify everything. Now let's talk history. Silver just closed February green. That's 10 consecutive green months. The last time we saw a streak like this was into 1980, when silver ran from 6 to 50 in about 18 months. Gold, 7th straight monthly record close. Longest streak since the early 70s. In just 2 months this year, gold's up over 20%, silver over 30%. But here's what most people are missing. Oil, gold, and silver are spiking together. Energy, monetary hedge, industrial metal, different sectors, moving in lockstep. When that happens during geopolitical escalation, markets are pricing tail risk. You've got rising tensions with Iran, hostage headlines, countries repositioning citizens. When hard assets move together like this, they're pricing supply disruptions, shipping route stress, currency instability, hundreds of billions added to the precious metals market cap in hours. That's not retail emotion, that's positioning. Does it mean war is guaranteed? No, but it tells you what informed money is hedging against. Now look at the divergence. Shanghai premium on silver sitting around $12, Western spot at $93.94, Shanghai spot over 100, futures even higher. That widening premium while price climbs? Physical and paper markets are pricing two different realities. Let's talk paper. Open interest on silver futures dropped from around 162,000 contracts to roughly 118,000 in a month. That's a 27% collapse, while price rallied from the 80s to the 90s. That's unusual. When price rises, open interest usually expands if new longs are confident. Here, it's shrinking. That suggests participants are stepping away from the exchange. Higher margins, liquidity issues, execution problems. When hedgers can't hedge efficiently, they move OTC. When they move OTC, transparency drops. And when dealers can't hedge properly, they protect themselves. That's when you see wider spreads. Higher premiums when you buy, lower bids when you sell. Not a conspiracy, just stressed balance sheets adjusting to risk. Pay attention to storage too. If someone offers extremely cheap or free storage, ask why. Businesses don't operate as charities. When your dealer is also your custodian and your buyback desk, there's a built-in conflict. Storage and liquidity are separate decisions. Treat them that way. Silver lease rates recently jumped well above recent yearly averages that hovered near zero. When lease rates rise while premiums widen and open interest falls, that's stress in the paper delivery system. It signals uncertainty around supply and confidence is everything in leveraged markets. This is the big swing environment. Multi-year deficits, central bank accumulation, geopolitical fragmentation, structural stress. These are not day trade narratives. They're macro cycles. Most people will wait for mainstream confirmation. By the time headlines say it's safe, the asymmetry is gone. Independent thinking means acting on probability, not waiting for comfort. Let's recap. 10 consecutive green months in silver, 7 straight record closes in gold, Shanghai premiums widening into strength, open interest down 27% while price rises, lease rates elevated, massive capital inflows during geopolitical tension. That combination doesn't happen in stable environments. It happens when something beneath the surface is shifting. Those who bought at 72 weren't guessing. They understood sentiment extremes create opportunity. The ones who panic during the next correction still haven't separated price volatility from long-term thesis. Going against the crowd feels wrong. That's why it works. Verify the data yourself. Study exchange reports, watch premiums, track sentiment shifts, build your own framework, and understand where your counterparty risk sits. This is Jhon OG.